Hi everyone. Good morning, good afternoon, good evening. Welcome to CoinGecko's 23rd virtual meetup. My name is Zhong. I'm the head of research here at CoinGecko. Thank you for coming in and joining us. So before we begin, I just want to thank our sponsor for this meetup, KuCoin. Thank you, KuCoin, for continuing to support us. So we're going to do two things. There are going to be two agenda items for this meetup this round. So to kick us off, I'm going to quickly run through a summary of our 2023 Q1 crypto industry report that we just published 2 days ago. So the full report is already available on our website at coingecko.com/research. But nonetheless, I'm just going to quickly run through some of what we think are the most important points so that you have a good overview of the report. And then after that, we're going to go into a very interesting panel discussion that we're going to have, where we're going to discuss the role of exchanges in Web3. So I'm going to straightaway jump straight into it. I'm going to run through, like I said, the summary of the report. And here we go. I think before we begin, shout out as well to 1inch for sponsoring this quarter's report as well. So thank you again, 1inch, for your support. I think from a total market cap perspective, this has been a very encouraging Q1. I think given all the horrors of 2022, right? And the market cap actually increased by 48.9% in Q1. This is largely supported by Bitcoin, and we'll talk a bit about Bitcoin after this, which grew at about 70+%. The good thing is, in addition to the total market cap going up, we also saw almost similar 30% quarter-on-quarter increase in trading volumes. This is not perfect yet. I would say the average trading volume sitting at around 77 billion. Just for a point of comparison, in the early days of 2022, even during the start of the bear market, we were still doing about a billion. So we still have some ways to go. So there's still some ways to go in terms of full recovery. Nonetheless, I think it's sort of pretty obvious. Every time there are major market movements, you're gonna see the volume spike, and we definitely saw that in the early in Q1, right? Even in early Q1 when the price was pumping, but definitely in the middle of March where the price saw jumped after the banking turmoil that happened in the middle of March, and where we saw the prices of crypto run up. It's sort of fallen off in the second half of March, largely because prices started to stabilize, and also Binance, which is the largest exchange, we can talk a bit about them later, started removing their zero fee trading incentives for most of their BTC pairs, right? Other important or other notable things to point out, I think Sol. I guess everyone is sort of saying that the chain is dead, but nonetheless, I think after a nightmare Q4, they actually recovered a bit of their market cap, and they actually climbed back into the top 10. Meanwhile, there was some QNT, CRO, and Ape fell of the top 30, but Filecoin, HBAR, and Lido sort of crept in, and we'll talk a bit about some of this. So it was really a green quarter for crypto. Going, if you just look at across all the different sectors and verticals, we're seeing all across it's mostly green except for Leo in the exchange tokens. In Q1 2023, obviously stark contrast against Q4 2022, where it was like a sea of red, right? As you can see on the chart on the left. Like I said, most of the gains in the total market cap was really carried by BTC, which grew by 72%, right? And it really did outperform most of the rest of the market. I think only Lido, LDO, GRT, the Graph token, and some of the play to earn tokens, some of the play to earn tokens, which saw outperform Bitcoin in Q1. Some other interesting observations, I guess, was that we stack up these top 5 tokens every quarter, and you'll see that some of the tokens have sort of changed position, and it's sort of a reflection of changes in the market. For example, Lido coming into the top 5 DeFi tokens is a reflection of growing LSD component in DeFi, and we'll talk a bit about that later as well. While some of the other DeFi tokens like Cake and Maker have sort of fallen out of the top 5 when they were there, sometime in 2022. Play to earn. I mean, like, sort of, people talk about GameFi is sort of dead, but nonetheless, I think it's worth highlighting that their tokens have come back strongly in Q1 2023. But they have suffered worse than most in 2022. So I think it remains to be seen, but it's sort of healthy and sort of some signs of positivity, I guess, for play to earn tokens. The Bitcoin's 72% gain also outperformed all other traditional major asset classes in Q1 2023. If you look on the chart, really, like, the only other asset class, or the only other major index that really saw a significant gain was the Nasdaq, which grew by 16%. While the rest really sort of stayed pretty flat. S&P was up by 5%, gold by 8%. Also, I think it's the top 3, the third largest gainer in this chart, whereas the rest of the currencies and the rest of the asset classes largely remain sort of flat. The only one that saw like a dip-ish was crude oil. I think this is more a reflection of the fact that it really saw a climb up in 2022, and we're seeing some of the supply shocks sort of dissipate, and sort of the supply pressures sort of dissipate in 2023, and this means cheaper petrol and cheaper oil for people, I guess, and that's sort of a good sign. I think, in terms of, it's not on the chart, but in terms of a correlation perspective, as you know, we sort of track BTC and S&P 500 quite closely. You'll see that in Q1, from a shape perspective, I think in terms of trend perspective, BTC and the S&P was still quite positively correlated. I think the correlation is about 0.3. Obviously, this is not the strong correlation that we saw in most of 2022, right, where it really, on an overall basis, it hit about 0.86. But nonetheless, I think it still shows that they're largely moving in the same direction. Just that BTC is performing a lot better, but also is a lot more volatile compared to the S&P. Changing gears a bit, I think moving to stablecoins. This is another sort of big topic or big area of focus for Q1 2023. There were some major events, obviously. Firstly with BUSD, right? As you can see, they lost about 54.5% of their market cap by the end of March, because there were US regulatory actions being taken against Paxos, which is the rightful issuer of BUSD, which ultimately led to Paxos deciding, okay, we're going to wind down the stablecoin, right? So that's one big I would say event, right? And sort of saw that really shook people's confidence in stable coins. The other event obviously was like in middle of March, when there was banking turmoil in the traditional markets, and because of all the issues with SVB, and then we sort of found out that Circle was holding some reserves for USDC at SVB, and that also caused USDC to temporarily depeg over in the middle of March as well. And you pretty much saw, I think, with all these trends, I would say the regulated US dollar or US based stable coins have lost significant market share in this quarter. So you can see, like I said, BUSD is down by 54.5%, USDC is down by 26.9%. The banking collapse as well, I think, interestingly, also saw two impact, or so one to point out is obviously Tether, which is the major gainer for this quarter. So a lot of people actually, if they were switching out of BUSD or USDC, they actually went into Tether. They are now at they have surpassed now 80 billion in market cap, which is the highest it's ever been. Other beneficiaries, I would say, from this migration out of USDC and BUSD was people like TUSD, right? So TrueUSD because Binance started minting it, and there was a lot of minting on Tron. They are now at 2 billion market cap. They are now top 5, squeezing out Frax, which is around 1 billion in market cap. The other stable that saw big gains was LUSD. They grew by 47.7%, off a largely, I would say, small base, simply because I think most of the backing for LUSD is in ETH, right, and was meant to be more decentralized and not wouldn't be affected by regulations. The other big shift I would say is people moving out of stablecoins. You see a negative 4.5% reduction in the total market cap. A lot of people started switching, with all these issues with stablecoins. A lot of people actually started switching into BTC and ETH as well, sort of trying to de-risk themselves from stablecoins itself. And we see that has also partially contributed to the increases that we see in the prices of BTC and ETH as at the end of March. Speaking of ETH, it sort of grew by 54% in the end by the end of Q1 2023. Certainly impressive performance, but again overshadowed by BTC. So I didn't put up a price chart of ETH here. I think for Ethereum, really, Q1 there was only the big focus was staking. With the Shanghai upgrade that eventually happened on 12th April, it just happened, and we're still seeing the effects of that. Nonetheless, I think if you look at the trend chart on the slides, you'll see that actually, total stake ETH in the protocol actually continued to steadily grow and had one of its best quarters in Q1 as Shanghai, the Chapella upgrade became more and more certain, and people were more and more confident to sort of stake their ETH in the protocol itself, given that it's pretty sure that you could withdraw it sometime in April. From a market share perspective, Lido was still first as of March at 31.4%, and really they were the fastest gainers amongst all their competitors. Nonetheless, I think we're still looking and we're still monitoring this. Chapella obviously happened successfully on 12th April, and we're trying to monitor to see how the stakes actually change between all of these providers. There are a few reasons for this. I think obviously one is Kraken actually settled the suit with the SEC over their staking service in the US. So you see a lot of the initial withdrawals after Chapella happened was from Kraken. Lido itself has not actually enabled withdrawals from their platform, so they are only going to activate withdrawals sometime in May after they finish testing that functionality. So I think that there's still a lot of moving parts to this. We're obviously also seeing other new service providers come to the market, and it's going to be interesting to see how the dust settles when we come back and look at this again, at the end of Q2, and how much ETH is still going to be staked in the network, and where are the stakes, who are the providers, I guess, that have actually benefited from the Chapella upgrade. So very exciting times, I think, and yeah, stay tuned for Q2 when we have a better picture of what the post Chapella landscape is like. The other interesting thing I would point out with Ethereum is we talk a lot about EIP 1559 and Ethereum burning and people saying ultrasound money, right? It's sort of a meme, and thus far, I think for those people that are hoping for a deflationary Ethereum, well, we just saw that in Q1 2023. It was really the first ever quarter, I think, the first ever quarter in history that Ethereum actually experienced a net burn of their supply, with a net of 75,000 Ethereum taken out of circulation, right? So 242k Ethereum were burned versus however much that was emitted throughout the first quarter. Yeah, I think no surprises that burns were higher when there were periods of higher transaction activity. That's how EIP 1559 was supposed to work. But also, I think equally interesting, if you look at the top burn leaderboards, you'll see that it is a reflection of who's contributing to Ethereum transactions, right? Uniswap still strongly in first place, and we'll talk about them slightly later. OpenSea has always been there, but you now see Blur squeezing themselves into the top 5, into the top 6. and Arbitrum as well, right? A lot of people were farming the Arbitrum airdrop, were bridging to Arbitrum, and you see that also being reflected. So no surprises here, but something to point out because it's important, especially for those that are bought into the ultrasound money narrative. Yeah. Moving on to DeFi, I think DeFi actually saw quite a good quarter as well. They sort of grew, or they sort of saw improvements in the price, at least pretty much in line with the market, slightly better than the market, and Ethereum at 65.2%. Bear in mind this includes only governance and utility tokens, right? So it doesn't include stable coins and wrap tokens in this. But nonetheless, I think it's still good recovery. Though again, not as good as BTC. BTC really was dominant in Q1 of 2023. The other interesting thing is in terms of the relative share of the different verticals within DeFi. So decentralized exchanges are still the largest. They still have about 44.3%. Sorry, they still have 39.7%, so about 40% of market share. But even though they continue to grow, I think they're actually growing slower than the rest of the market. Oracles, largely due to Chainlink, still retain at second place, but liquid staking has now overtaken lending as the third largest sector in DeFi, at least from a market share perspective, right? And I think that's a reflection of tokens such as LDO, Ripple, FXS, which now has Frax, which now has their own version of liquid staking as well. Saw a 210% increase in market cap in Q1, and that has actually taken them ahead of lending protocols such as the usual suspects, Aave, Compound, etc. The other I would say prevalent trend in Q1 is the continued growth of derivatives, insurance, and fixed interest protocols, which has really surged in popularity. I think almost doubling their market cap over the last quarter. I think this is probably a reflection of people looking to hedge, people looking for some downside protection, or people looking for real yield, right? So looking for some sort of more stable, predictable yield in a pretty volatile market. Obviously, also not discounting, with derivatives protocol in there. A lot of people are also going on leverage to try to capture the upside from the bull market. From a TVL perspective, I think not much has changed here. I just want to point out that it grew by about 14.8%. Not that much as you would have thought. I think largely TVL has sort of stayed, has not recovered as much as we would hope. From a breakdown in terms of chains perspective, Ethereum has slowly and steadily continued to regain its share of TVL, right? If you look on the chart, October it was 61%, it's now at about 66%, and pretty much every month you see it slowly creep up. I think Arbitrum obviously was one of the key protagonists or key focus L2s for Q1 2023. They saw their TVL rise by 83.4%, going from 31.9 billion to 58.5 billion, right? So I think what's probably more interesting is that they've actually largely been able to hold on to that TVL even after the airdrop has happened. So I think that's positive signs for the Arbitrum community. They've managed to hold on to TVL, which largely even after the launch of things like ZK Sync, Era, and Polygon ZK EVM, and which indicates, I think, that to a certain extent, like they're still able to hold on to their community even though airdrop is done, and this is typically the point where you see outflows in sort of interest and outflows in TVL in actual quantifiable matrices because of farmers and stuff like that. Yeah. The last point here is Solana. So even though they're which used to be at one point the second largest DeFi chain out there, their TVL continue to deteriorate, unfortunately. From from a share perspective. Sorry. So even though the token price may have recovered and the TVL may have recovered slightly, it's still not back to where it was clearly. And its share of TVL actually has continued to decrease from 0.78% to 0.72%. So a shame, but it is what it is at this point in time, and I think that's a long way back to where it was, certainly from where it was in 2021. Yeah. Moving on to NFTs, this is one of the big stories of 2020 Q1 2023, which was the rise of Blur. It really started in October, right? You see it as a small point, but really it has continued to grow and take market share, either depending on how you look at it, either away from its competitors, such as OpenSea, X2Y2 or LooksRare, or it's continued. It actually has been able to grow the pie of the NFT market. So around the same time that Blur was gaining prominence, we actually saw, I think in Q1 2023, a 68% increase in trading volume, right, for NFTs across the top 6 marketplaces. More than which is almost double. 68% from December to March. So but for a quarter-on-quarter basis, this is close to double. It's double of what the market did in Q4 2022. So this is a good sign that volumes are coming back to NFTs as sort of the market recovers. The other thing, like I pointed out, was Blur has dethroned OpenSea now. I think this the first time this has happened was in December. OpenSea recovered slightly in January, but February and March largely was Blur being in the top spot, and they have sort of retained their position again. Similar to Arbitrum, despite having already done their airdrop. But also, I think sort of promising a second round airdrop for season 2. So perhaps a lot of people are still on there farming. But nonetheless, I think the stats that we provide are excludes wash trading. So it's still pretty impressive that they've been able to hold on to this much volume. The other thing I would point out from this is Magic Eden, which was at one point close to OpenSea. So if you look in November, it actually did almost as much as volume as OpenSea did, being mostly dominant on the Solana chain. But unfortunately, I think with the demise of the Solana ecosystem as well, Magic Eden's share in terms of between different marketplaces have also collapsed. And they are now in 5th place in the ranking. So it's a shame, but they continue to persevere, I think, and you'll see that we have seen them launch on Ethereum to compete. We have seen them launch on different chains. We have seen them even launch a Bitcoin Ordinals marketplace. So hopeful to see how they can compete in this new market environment. Speaking of Bitcoin Ordinals, I think we did a quick brief of this. This is again another interesting innovation that happened, especially on the oldest chain out there. I think very interesting, and people can have a read in how it works. But I think safe to say, even though there was a bit of controversy when it launched, it was quite a bit of controversy actually when it launched. People arguing about whether the chain should only be used for payment transactions, and NFTs it was not the intended use case of Bitcoin. I think nonetheless, I think the Ordinals crowd has won from now. There's about 663,000 inscriptions that have happened by the end of March, and we still see inscriptions launching, new NFT collections launching on Bitcoin Ordinals. So I think safe to say they're trying to build out a NFT ecosystem right now on Bitcoin. It's also helped by major platforms or major NFT brands moving into Bitcoin Ordinals as well. So big names like Yuga Labs have launched a new 12-fold collection on Bitcoin Ordinals done through an auction. And like I mentioned before, Magic Eden also launched its Ordinals marketplace in March as well. So good signs, good start for Bitcoin Ordinals. And I think the next step really is to build out its own blue chip collections and see whether it can hold it can hold and sustain an NFT community to sort of compete with Ethereum as well. Final two slides. I promise to be fast. I think, from a volume perspective, we already talked about this. We really should be doing about 1 trillion a month, but we're not there yet. But we are getting close. So you can see for January, February, and March, we are seeing some form of recovery, right? After November and after a really terrible December. So good news for exchanges. I think the other interesting thing to point out, obviously, is the centralized exchange to decentralized exchange. So CEX versus DEX ratio has actually been slowly improving. DEXs actually grew by about 30+% over the first quarter, right? 33.4% versus 16.9%, which is sort of an interesting sign. I think actually this ratio hasn't moved really that much throughout 2022. But I think given all the challenges with exchanges, particularly with Binance, the largest exchange being targeted by US regulators, seemingly, seems like most people are actually migrating to CEXs, to DEXs for their trading activity. The big winner for DEXs have actually been Uniswap. They now control about 70% of the total share of like DEX trading volume. So they continue to grow from strength to strength, especially now when they continue to deploy to many different chains. They've sort of successfully branched out of Ethereum. The other interesting DEX that I would point out is Trader Joe, which started on Avalanche, deployed on Arbitrum just before, close to the airdrop season, and actually have seen them gain quite a lot of trading volume. They are now in top 10 in terms of DEX trading volume. From a centralized exchange, centralized exchange perspective, I think no surprise that Binance is still number one, even though their market share have actually fell back in March. It's so interesting because obviously all the regulatory stuff came in, but they also removed the zero fee trading for most of their BTC pairs, which probably contributed to also them losing market share in the market. So it shows that actually the market is quite sensitive to these things. Will be interesting to see, I think, next quarter to see where they end up and how they end up. Yeah. Last slide for me for this section. I think these are derivatives exchanges, and we're looking at perpetual swaps volumes across all the different perpetuals that we have out there. Pretty healthy, and it sort of grew faster than spot exchanges. It grew by 36.2% compared to what the spot exchanges did earlier. So it's now done 7.1 trillion in trading volume in 2023 Q1 between the top 10 perpetual exchanges, and this is 2.6 times the size of the spot market now. So there really is indication that a lot more traders are moving towards perpetuals, getting familiar with perpetuals to sort of take position in the market, whether that's long or short. From a market share perspective, Binance again still retains top spot. They managed to hold on to their market share in the perpetuals market about 60%. It is a dominant position, even though we are seeing some small declines across Q1 as sort of other exchanges come to the market. Obviously, the other story was FTX collapsing in November. They obviously had a significant share of the market in 2022, but I think after their collapse, I think with 2023 a new start. So OKX and Bybit have sort of cemented their position as number 2 and number 3 respectively, at least in terms of trading volume. Bybit is ahead a bit if you look at it from an open interest perspective, but they have cemented their position as the number 2 and number 3 perpetuals exchange in the market. Yeah, so this is the end of my summary. Like I mentioned at the start of the presentation, if you would like to have all the details, if you would like to read the full report, it's already available on our website at coingecko.com/research, and you can find all the insights and all the information there. So what we're going to do is we're going to take a quick break, and we're going to come back and talk about the role of exchanges in Web3 with our panel of distinguished guests. So hang on tight. We're just going to take a quick break, and we'll see you after this. Hi, everyone. Welcome back. Thank you so much for staying with us throughout the break. Welcome to our distinguished guests. So this is the second part of our meetup. And, we're going to talk about the role of exchanges in Web3. And joining me today, I have, two distinguished guests that have joined us. We have Alicia Kao, who's the managing director of KuCoin, as well as Nathan Cha, the marketing lead for DYDX. Welcome to the both of you. Thank you for joining us.
Thank you for inviting us.
Yeah, thank you. Good to be here.
So I'm going to jump straight into it. And what we're going to do is we're going to run through a list of questions. And maybe if we have time at the end, we're going to pick up some questions from the audience as well. So I think let's talk a bit. We've gone through the presentation earlier, obviously, but I wanted to start with the spot market and really question going to Alicia first. I think it's been a challenging year for spot market to say the least, right? At least in 2022, with volumes falling to much lower levels compared to 2020 and 2021. Perhaps you could tell us a bit about how KuCoin and yourself, you guys have weathered the bear market. Are you seeing a recovery? Are there positive signs that people are coming back into the market? So.
Yeah, so I've been with KuCoin for 4 years, and I think every year is a challenge year for us. And the key to overcome the bear market is always to keep building. So I think I would say there's not much difference between like the bear market and bull market for us. But during the bear market, we could see our users became more carefully and they got more time to do research on what they're gonna invest in. We still have millions new registered every month. So I think there are still more and more people interested in crypto industry and also the crypto assets. So since the user base are increasing, and I think they're just waiting for the right timing and the right target to invest. So instead of just focus on the number of trading volume, I think the number of daily users could shows that we can still have confidence of the market. So just be patient.
I guess that's the spot side, but what about the derivative side? Because from our end at least, we saw an uptick in the volume in the middle of 2022, and then it sort of was all right. I think comparing derivatives market to spot. I wonder if you could offer a bit more insight on that. Do you see more people moving into derivatives, moving into perpetuals?
Yeah, definitely. So we can see booming of the trading for the last couple months, especially during the bear market compared to the spot market. So I can share some rough numbers to give you some ideas. So for the major tokens contracts, such as BTC, ETH, and across the whole futures market, compared to the end of the last year, we can see average open interest in for the retailer investors increases more than 50%, which is quite large. And max trading volume of single days increased to 5 times of the average. So and average number of the daily trading customers also got doubled. So we can see there are like definitely more and more users max out the leverage to trade as well. So I don't I don't know whether it's a good thing, because we always want our users to like to like not that like irrationally, right, to trade their crypto assets. And so it also give us like more time to educate our users and to improve our products and also our trading system to make sure like when the next bull market comes, we are like totally get ready for that.
Okay, that's interesting. I think people are still going max left even during the bear market, right?
Yeah,
I,
crazy.
yeah, I think Nathan, what about on your end? I mean, DYDX is a very derivatives focused one. Do you see a lot of degen activity happening on your exchange even throughout the bear market, or give us an idea
Um,
how it's
yeah,
going?
so I think there's always degen activity when it comes to derivatives, but there's also some sophisticated trading activity too. I do know that in general, derivatives markets and synthetic markets always account for more of the total trading volume in the crypto ecosystem than spot does. So I think roughly 80% of total crypto trading volume is accounted for by perpetuals and derivatives. And of derivatives, perpetuals account for, by and large, the most volume. So I think that this is a trend that will continue, even in TradFi markets, and especially so the amount of volume that moves through synthetic assets and derivatives as opposed to actual stocks themselves is magnitudes of orders of numbers higher. So I think the actual percentage wise, the crypto markets have a while before they catch up to TradFi markets in that regard. But I think that the health of the derivatives ecosystem is here. I think it's here to stay. So we'll continue to see this moving forward.
And do you see have you seen like growth throughout the bear market, or how would you characterize the volumes that you're seeing coming through DYDX?
So I think it's been a healthy balance. I think like anything else with the bear market, you do see some declines in overall trading volume in the crypto ecosystem, but at the same time, unlike spot, I think derivatives just give you a lot more ability to trade in different ways. So you can hedge, you can go short, you can use more leverage. And also, I think a big part of the reason why people are drawn to derivatives in particular is that because they are synthetic assets, like I mentioned before, you're not limited by the actual supply of tokens that are on chain. So, for example, if $1 million worth of Bitcoin or 1 million Bitcoin are tied up and people are not selling them because they don't want to sell at a loss during a bear market, that doesn't impact your ability to trade the synthetic assets. So you're able to trade and have more exposure on a derivatives exchange or by trading derivatives. I think also is the fact that with the FTX implosion recently, we've seen an influx of traders come to DYDX because of the value propositions of a DEX, as well as the fact that traders are still looking for venues to trade these derivatives, even if they can't trade them on FTX anymore. So DYDX has definitely been a beneficiary in that regard as well.
Okay, yeah, that's interesting. I think what when we speak about derivatives, we talk about the degen people, but clearly it's derivatives, perpetuals and futures, they're the realm of institutions, right? So I was wondering, I think Nathan, from your perspective, DYDX is sort of a decentralized exchange, or at least partially decentralized exchange. I was wondering if from your perspective, are you seeing institutional flows? Do you see institutions actually getting comfortable using decentralized exchange, self-custodying and all the things that comes with using an on-chain DeFi protocol?
Yeah, definitely. I think we've already started to see an influx of institutional flow on DYDX and derivatives exchanges in general. Obviously, I think that there's different concerns for institutions as opposed to just general retail traders. So, for example, AML is something that really matters to institutions. They don't want to be affiliated with any potential money laundering or any negative agents that might be doing so. So I think the big part of the onus to get more institutional flow is actually on the exchanges to make sure that institutions are comfortable with trading on derivatives exchanges and DEXs particularly. So for example, on DYDX, for any institutional funds that try to onboard to the exchange, we do OFAC checks to make sure that they're not on any flagged lists that would potentially cause issues. I think for the most part, self-custody is something that most institutionals are actually quite comfortable with at this point. Their main concerns are also have to do with the actual product experience themselves. So for example, if you're a high frequency trading firm, you don't want to see high levels of latency. So it's a product experience on a DEX, actually something that is sustainable and something that you can execute your trading strategies on. So those are the types of things that I think institutional funds and institutional players are looking for when they're trading crypto derivatives. But by and large, I think that flow has already started to income and it will only continue to increase in the future.
Yeah, I think the product offering question is quite interesting. I just wanted to turn that to Alicia. I think looking from, you're a centralized exchange, obviously. So from your perspective, what are you seeing from an institutional angle, and are you creating tailored products that cater specifically to them?
Yeah, so I think Nathan just mentioned that like all the things matter are about the speeds, right? Especially for the high frequent trading firm. So we are also trying to upgrade our trading system to provide a better trading experience on the latency and the request limits, and also like sub accounts. They got like lots of different needs than the retail users. So we got our focus are from the beginning would be the retail users. So we got lots of retail users. So like we still got lots of spaces to improve our products for the institutional clients. Yeah.
Yeah, thanks for that. I think that's quite interesting, and we definitely look forward to what's coming. But I think certainly from a centralized exchange perspective, I think everyone sort of started off as simple platform for people buy and sell, and sort of all these products have sort of mushroomed up over time, right? And we see exchanges adding more and more offerings to cover more products, right? So a lot of exchanges now have say their own staking product, their launchpad, whether, or maybe they're helping their customers do some liquidity farming with DeFi protocols. I just wanted to ask, I mean, like, is this sort of an obvious sort of evolution that every centralized exchange is going to go through, right? Like everyone is sort of going to become like a full service centralized exchange that can offer everything to their customers. Do you think this is sort of the natural evolution of centralized exchanges?
Yeah, seems like that because I think it's all because the decentralized exchange, we are taking the responsibility of mass adoption for the industry. So which means we need to fulfill our users' need of every step during their like crypto journey, right? So I don't see it as a evolution because I think it's because we do have a whole picture of what we're gonna do for our users, and we're just puzzling our service piece by piece. So from finding out those outstanding projects and list them on our exchange, and also to build a reliable infrastructure to help our users to trade their crypto assets safely and efficiently. So asset platform and compared to the traditional finance system, which people could manage their assets. We still got like lots of things to do for our users. Yeah.
Yeah, certainly. I think, quite interesting that you said that, you guys are responsible for mass adoption. And
Yeah.
certainly, I think it does feel like that for now because, people usually when, a normie or a new user to crypto comes to crypto, I think the one of the first places that they're going to interact with is a centralized exchange. I think, Nathan, from DYDX perspective, so on-chain DEXs tend to go the other way, right? So it really feels like it's a completely different approach and philosophy in the sense that on-chain DeFi protocols, on-chain DEXs, they just want to do one thing and they want to do it very well. I sort of wonder, why do you think that's the case? And is it because people just started out this way and sort of that's the way that everyone sort of just went with?
So I think the primary reason for that is boils down to innovation. So like you mentioned, the aim of decentralized exchanges is to be fully on-chain, right? So the compromise that you have to weigh is always how do we get max throughput and do not sacrifice on the product experience itself without compromising block space. So that is generally the battle that most DeFi protocols are struggling with is how do we do this in a way that we don't sacrifice on the product experience, but at the same time, we can offer the main tenets of decentralization. So governance, self-custody, those types of value props that matter to our users. That being said, I think that we're getting to a point with DeFi where the innovation is really starting to progress much faster than it has in the past. So I think the sky's really the limit here. We can talk more about V4 for DYDX later, but I think that right now, for example, DYDX exclusively offers perpetuals. But once we launch the V4 standalone chain, we're customizing that chain specifically so that we can maximize throughput. And right now we're a hybrid DEX. So our order book is actually off chain on L2 Ethereum, but that order book will become on chain. So I think that there's very much so a world in the near to medium term future where we start to see derivatives exchanges starting to expand their product offering beyond just like a single product offering, like exclusively perpetuals or exclusively spot trading.
And what do you think is sort of driving this change? I think with AMMs, they've already started to do some of this, right? Some AMMs are bridging into lending, or they're doing cross-chain swaps, or some people are talking about like we should have our own stable coin. Is it going to are we going to see this evolve in the next few years in the sense that everyone is also going to be full service, or sort of like they all want to build out their own lending protocol because they've managed to sort of capture certain users' attention, I guess.
Yeah, so I think it really depends on a protocol by protocol basis. But I think at the end of the day, there's two driving factors for this expansion. The first one is that the tech has been exponentially improving over a year. So 5 years ago, we wouldn't have been at the point where a DEX could offer multiple different types of services like they can potentially either this year or like in the near future. The second thing is I think that there's a legitimate consumer demand for it now. So we've seen centralized exchanges have similar types of implosions as FTX before in crypto's history. I think people are starting to understand the value of self-custody much more than they had in the past, and understanding the importance of being able to know exactly what your funds are being used for and where they are at all times. So this matters a lot for users, because you don't want to execute sophisticated trading strategies, be extremely profitable, and then see the money just disappear. And people aren't okay with that anymore. So I think a big part of the reason why these DeFi protocols are actually expanding and starting to offer more products and more of a expansive product suite is because people want to see that out of the DeFi industry specifically.
Yeah, I think changing gears a bit, I did want to move away a bit from DeFi and finance and talk a bit about NFTs. Obviously, NFTs really came a lot more recently compared to DeFi and trading tokens and things like that. But I think we've seen people try with NFTs, right? And largely, I think the successful ones have been those that are native NFT platforms, should I say, like OpenSea and Blur. And over 2021, 2022, we actually saw centralized exchanges try their own NFT platforms as well, but none of them really managed to succeed. So I guess question to Alicia first, like why do you think that's the case? Like are NFT people just sort of different from the coin trading community, and they're just a different crowd that is too difficult to tap for a centralized exchange?
Yeah, so first of all, define succeed, right? So I think the concept of NFT is quite interesting, because there are so many different types of users, and each of them got their own definition and goals. So for those crypto native users and projects, their crypto journey mostly start from decentralized platform, right? So I think they don't trade altcoins frequently, and so which would be so different from the decentralized exchange, because most of users start their crypto journeys with us are from to trade the altcoins, right? So so because it's so different of the user base of centralized exchange and decentralized exchange, I think both of sides are willing to cross over and to trying to expand their markets, right? And I think not only centralized and decentralized platform, it also includes Web2 and Web3, right? So I think just give us some more confidence and some more time, and before we talk about performance or numbers, we still have to build first, right? So yeah.
Yeah, I do think the NFT space will continue to grow, and like you said, there are a lot more Web2 companies coming in, right? Reddit has been particularly successful. Starbucks is trying new things. So it's still early days for NFTs, and yeah, like you said, perhaps it's still too early to judge, right? Like who are the final winners or from the NFT market. But yeah, but I think, Nathan, from DYDX perspective, I think obviously from an on-chain perspective, right? Uniswap actually went ahead, tried to bridge over and acquire Genie, with and it really is the first instance of like a DEX that is now trying to get into NFTs. Do you think that that is also a trend that's happening on chain? Like the token crowd, the crypto Twitter crowd, I guess, is trying to bridge into the NFT Twitter crowd, or actually try to capture some of this, and yeah.
Yeah, I think just in general, I think the overall crypto ecosystem is becoming a lot more sophisticated than it was like 5-10 years ago, as we started to see a lot more altcoins pop up, more and more mass adoption of Bitcoin and Ethereum, and just casual people come in and buy spot. I think that the overlap between whether it's degen traders or just traders of altcoins who are trying to see as much yield as possible on profits, and NFT traders, I think that we're starting to see people start to dabble more across different types of asset classes. So I think you'll definitely be a trend, as mentioned before, that DeFi protocols start to expand their product offerings, because at the end of the day, I think most traders want to be able to trade all their different asset types in one place. So I can't say it's a shock that Uniswap is starting to dive into NFTs, for example, because if there is a significant overlap between the people who are swapping their tokens for altcoins or anything like that, they also might want to be able to trade their NFTs on the same exact platform. So I don't know exactly what DeFi protocols will prioritize first, whether it's NFTs, lending, staking. I think that there's a vast variety of services that currently exist in the DeFi ecosystem and crypto overall. So I think it'll be very interesting to see how it plays out. But I definitely think that this will be a trend that we continue to see.
Thanks for that. Changing gears a bit, I think one of the big themes of Q1 2023 was regulations, right? And it's unavoidable that at some point when you operate an exchange, eventually you're going to run up against some form of regulations. And I think the big message that seems to be coming out of Q1 was that the US regulators were certainly getting a lot more aggressive, we saw today that Europe just signed MiCA into force, right? So European regulations are sort of bedded down, which is a good thing, and then sort of coming. I guess, Alicia, I mean, do you worry about sort of tightening regulatory environment for centralized exchanges? There are some places that I think at the same time when certain places are sort of introducing regulation, there are other places that says come to our shores, right? Our jurisdiction is a lot more facilitative, and we can let you guys operate with some level of freedom. So I'm wondering how are you thinking about this regulatory environment? It's certainly getting more complex, and how do you intend to sort of chart your way through this?
Yeah, I think along with the massive growth of the crypto market, governments in worldwide, like every government, they're working on regulatory to try to protect their people, right, away from scams and crimes. But most of people don't follow up every movements by every government. So what we read on news, what we heard from other people to talk are mostly lawsuits and scandals. So we are paying attention to the regulations, and we can see instead of just trying to copy the regulation of the traditional finance, there are also some new regulations that designed for the crypto industry in the beginning. Right, I think that's quite a good thing. So we got some good starts, and I'm so looking forward to see more and more regulators to come up better solutions after they got to know more about this industry, like the whole blockchain things and also the crypto things. So I think it would be more clear and complete, not only just tightening or untight. Yeah.
Yeah, I think just looking at some of the audience questions, I think Nathan, you mentioned you run OFAC checks for some of your institutional clients, for all of your institutional clients. I shouldn't say some. When they come on board and sort of trade on DYDX, I was just wondering, if you have any thoughts regarding KYC and whether you see that on-chain protocols, DeFi protocols will eventually sort of move in that direction, and they will be forced, whether by comply or how is DYDX thinking about this?
I think lack of KYC is something that our users generally very much care about. And that's one of the key differentiating factors between a DEX versus a centralized exchange, right? The whole point of decentralization is the ability to trade with relative anonymity outside of a wallet address that's public, self-custody of assets. So at least at DYDX, we have zero plans to ever enforce KYC or make it mandatory. We never have. And that won't change. If anything, we're moving more and more towards full decentralization. As I said, there are certain aspects of DYDX today that are more hybrid than they are just fully decentralized. So for example, our current order book is actually off-chain, and it has a matching engine. So moving forward, I think decentralization is going to become more and more of an important value proposition for a lot of crypto users in the ecosystem. So from our perspective, we still have never operated within the US just because compliance is still a little bit unclear, like how that's supposed to look. But we are making an effort on our end in terms of policy to make sure that we're in the room to make sure that we have sensible legislation and regulation when it comes to educating policymakers to start moving us towards the right path. So for example, in the US, I think at this moment in time, there's definitely a little lack of clarity in terms of how you're supposed to function here. But at the same time, for the DeFi ecosystem in particular, I think it's a specific sector of crypto that a lot of the regulators don't really understand yet. So DYDX recently hired a head of policy within the last year just so that we can start working on that education focus so that when it comes time for regulation to start happening and legislators to start paying more attention to DeFi specifically, they actually understand how the products work and like why they exist. That being said, I think that for a DEX to start mandating KYC just goes against the entire ethos and purpose of DeFi in general. So DYDX 100% will never force KYC, and I think we'd be very disappointed to see other DEXs claim to be DEXs and make their users go through KYC to onboard.
Yeah, I think certainly like you said, I think and Alicia alluded to as well. I think crypto is a fast moving industry, right? And constantly, I think we're trying to keep up, and I can't imagine it's even harder for regulators to keep up, and we need to play our role in and further engagement and sort of bringing them up to speed on the latest developments and helping them understand better how the space sort of operates. Just changing gear, and I think we talk a lot about what has happened in the past year and the past quarter. I just wanted to ask some questions that are sort of looking ahead to a bit of the future, and maybe take some audience questions after that. I think Alicia, I think from a centralized exchange perspective, right? We've seen some of them collapse and over the past year, and it's not been great. But I would say one of the very positive things that actually came out of this is the ask for more transparency, and a lot of exchanges have very quickly introduced proof of reserves as the first step to show, right, that to reassure clients that funds are safe. You can sort of trust us, and we're hopefully we're not gonna gamble away your funds. Do you think this has helped in bolstering user confidence, and you see this as positive steps for the industry?
Yeah, sure. I think because like centralized or decentralized are never the problems, right? The problem is if you could keep the user's funds safe, right? So in any ways, like just not to like not like just stop somebody to trying to steal the funds, right? And so I think the proof of reserve could answer the concerns of most of our users, because they only need to confirm if they're like if my $100 are still there, right? And nobody like took them away. And I think that's the key. So the proof of reserve can like answer the concern like mostly, I think. Yeah, so we are now like update the report monthly every month, and we are also looking for some other solutions or other like tech services to help us to raise the frequency of the reports. Yeah.
Nice. Nathan, I think from DYDX perspective, like you said at the start of earlier in the call, I think V4 is coming. You've just launched it on private testnet, and you guys are making the shift to Cosmos. Tell us about it. What's new, what's coming, what can people expect, to improve, and sort of what is the new experience that you guys are hoping to offer.
Yeah, so I think related to the last question, transparency is really important. So I think our perspective probably differs from Alicia's and most centralized exchanges, that we don't think that proof of reserves is nearly enough when it comes to transparency. And the large reason for this is that proof of reserves just is a wallet address, for example, that shows how much funds are on there. But it doesn't really tell you anything about a company's balance sheet, any outstanding loans. By contrast, the DYDX smart contract is fully auditable. So you know exactly where the money is, exactly what's happening on chain, that is readily available, auditable in real time. You don't have to rely on some sort of third party to audit that for you, because you can do it in real time, any time of the day. With V4, I think our ambition was to become even more decentralized than we are now. So like I mentioned before, the order book itself will be on chain. Again, even more transparency than exists today. We also were very optimistic and bullish about moving to Cosmos and developing a standalone chain, because what that allows us to do is increase our throughput even more. So DYDX has always taken the stance that we're willing to take bold risks as long as it's in the best interest of the product. So we were one of the first exchanges to move to an L2, even though that decision wasn't popular at the time. And the main reason for that was lower gas fees, higher throughput, better product experience. That's the same thing with Cosmos. So Cosmos, with the standalone blockchain that we've customized specifically for our product offering, is orders of magnitude higher throughput than any L2 that exists today. So you have to keep in mind with derivatives exchanges, there's a lot of orders that are being placed, canceled, that are all going to the chain and the order book at any given point in time. So what we were facing issues with was, as we continue to add more markets and onboard more traders, this was becoming an issue in terms of scalability. So moving to Cosmos allowed us to have magnitudes of orders higher when it comes to the number of orders that we can support and markets that we can support. So even from a product experience, beyond just decentralization and more transparency, we were very happy about moving to Cosmos because it was the best decision from a tech stack point. So with V4, I think what also happens is that, like I mentioned before, we become more decentralized. So beyond the order book, I think the actual exchange itself becomes a lot more decentralized. So through governance and DAOs, a community of users and token holders can start to decide what actually do you want from the exchange. They have a lot more input and ability to vote on what the product experience becomes. So do you care about us starting to offer spot? Do you care about more markets? What other aspects of the product are the most important to you that you want to see built? And that's something that's only possible with more decentralization, because the community gets to buy in. So from all standpoints about like what DYDX's value proposition is around decentralization, as well as the actual experience of the product itself, Cosmos was pretty much the best decision that we can make at this moment in time. So that's why we're very excited about V4 and moving off of L2 to Cosmos.
Okay. Thanks for that. I think exciting times to come, and we certainly look forward to V4 launching to more users so people can play with it. I'm going to move into some audience questions, and before we wrap up, I think this one goes to Alicia first. The question is that we've seen in 2021 that KuCoin experimented with KCC, your own native network. I think we've also seen other centralized exchanges launch their own networks as well. I'm just curious, talk to us a bit about the motivations of why, and do you see this as a key sort of value proposition or a key driver for you to acquire customers?
Yeah, I think being a centralized exchange sometimes like a little bit like awkward, because I think that the whole the core concept of the blockchain would be decentralized, right? But still we don't want to miss the trends, and also we don't want to miss the tickets in the future of the decentralized world. So that's why we launched our own community chain, and it helped us to get connect with those projects like decentralized the apps, right? Decentralized applications, and gave us some chance to work with them to help us to not to miss the trendy things, and also the latest information or latest technologies. And so we do work with them, and we got our own incubation program, and we help them to launch their products on our public chain. And I think it does help us to get know more about those new projects and the new teams. And I think we're going to keep putting like more efforts and resources to this business. And yeah, I think we are not doing that well, but at least we're just keep building. Yeah.
Yeah, I think people do, in different parts of your business has serves different purpose, right?
Yeah.
And if it helps you, keep in touch with the latest stats and what people are building on
Yeah,
chain,
that would be absolutely the strategic movements for us. It's quite
yeah.
important for us to get into the decentralized world, right?
Yeah. Coming to Nathan for the next question, I think this is about decentralized perpetuals, right? It's sort of like an ongoing trend, and I guess by extension, decentralized futures and options as well. We see this starting to proliferate across different chains as well. Do you worry? I think about liquidity being fragmented. I think this is always a challenge with sort of decentralized exchanges, which is there are a lot of people farming, and sometimes a new protocol will crop up and offer incentives, and then people will move, and how do you think about fragmentation? I mean, even going across different decentralized derivative protocols and even different chains, right? Like people are moving to different L2s and things like that. Yeah.
Yeah, definitely. I think that obviously the liquidity is really important for the health of any exchange. So that's definitely something that DYDX is always monitoring. I think that we're in a very good situation in that sense because we have very healthy liquidity on DYDX's exchange. We have plenty of market makers, and generally speaking, I think market makers just follow retail flow. So as long as there's people that are actively trading, market makers will be there to provide liquidity. That being said, yes, there's obviously fragmentation in the market. We'll continue to see more perps dexes happening, popping up as they continue to try and compete and offer their product and give users some sort of value proposition or reasoning for why they're the best dex or they're the best experience. That being said, I think since we're the market leader at DYDX in terms of overall trading volume as a dex, I don't anticipate that's changing. Maybe that's optimistic, but from our perspective, liquidity, even through this bear market, has been extremely healthy. We've weathered the downturn very well. And with V4, we're already in the private testnet, which is performing very well. Public testnet will ship by the end of July. So we'll continue to monitor the situation, but we're already seeing institutional players and market makers buy into decentralization and our mission statement. So they're willing to move over to a fully decentralized protocol with us, and that hasn't been an issue so far. Obviously, they have concerns about like different aspects of the protocol, and that's why we have the testnet running, right? To figure out what the bugs are, how do we fix them, make sure that once the mainnet's actually shipped, these aren't issues. But that being said, I think that as long as you offer a best-in-class product experience, traders will go there. And if traders go there, liquidity will be there as well. So at the end of the day, as long as DYDX, as from our position, offers the best product experience possible, like I mentioned, the rationale for why we're moving to Cosmos, then I think that liquidity really won't be an issue because it hasn't been an issue for us in the past.
Okay. Interesting question that sort of popped up, and I think this is more of a product question. I think So there's a question is will we see NFT perps? So this is an interesting one. Yeah, will we see NFT perps on DYDX or KuCoin? And do you see yourselves offering this sort of product? And sort of what are some of the possible challenges in implementing this sort of a product? And I'll open it up to like either one of you, maybe want to talk about NFT perps. I'm not sure if anybody has thoughts.
Great question. I think that it's entirely possible that this happens eventually. I don't think that we're at the stage yet with NFTs for any protocol to really offer these yet. And I think that the reasoning why is that consistent pricing is really important for perpetuals. So for example, at DYDX, we use Oracle prices. And the reason why we need consistent prices is because perpetual is by nature a lot more volatile than spot assets. So you need the actual price of the underlying asset to be relatively stable for you to be able to price those assets accordingly and for that pricing to make sense. With NFTs, I think this is a little different because the buying and selling of NFTs is not like traditional, like spot, like equities or crypto assets, right? There's a floor price when it comes to NFTs. That floor price can oscillate, but that floor price isn't necessarily what the actual NFT sells at either. There's varying degrees of demand for individual types of NFTs, and even within like families of NFTs, like cryptodes, for example, or Bored Apes. I think that the pricing across those different NFTs is so distinct that it's hard for you to make a all-encompassing perp class or for like even families of NFTs yet. And then if you were to go into individual NFTs specifically, the question would be, is there even enough liquidity for you to offer a perps market for that? That being said, 5 years down the road, 3 years down the road, even 10 years down the road, who knows how NFTs will evolve? So from our perspective, I guess it would really be like, is there a demand for NFTs, and would that demand be met with enough liquidity to actually build a market for it? And if that's the case, I think it's highly possible that whether we at DYDX offer that or someone else does, that would become a product offering. I just don't think that that's a reasonable or like possible thing to happen at this moment in time.
Yeah, I think before the NFT perps, we have launched a couple of fractionalized NFT tokens that help our retail users to easily trade on our exchange. I think I think it's like largely help those NFT projects of their liquidities and their like user acquisition, and we are still monitoring the numbers, like the daily trade users of those fractionalized NFT tokens, and I think they are quite popular, because most of our users, they don't have that much time to do the research of each NFT of the whole NFT collections, and also like to have their own decentralized wallet to connect to like the OpenSeas or Blur or other NFT marketplaces. So I think before we jump to the NFT perps, like I think we have a great start just from the fractionalized token. Yeah.
Yeah, and I think certainly, I think there are different approaches and different ways
Yeah.
to speculate on NFTs, and yeah, I think fractionalized is one way, perps is another. Yeah, I think it still remains to be seen where the market will go, but certainly interesting interesting things coming to the NFT market. I think just to wrap up, we're almost out of time. I wanted to sort of ask, like the topic of today was the role of exchanges in Web3, and I really wanted to ask, how do you think the role of your exchanges will shift, right, in the future towards trying to onboard new users, and bringing more to the table for your existing users. What more can exchanges do, what more can your exchanges do to sort of help us onboard the next million and the next billion users to Web3? Alicia, maybe you want to go first?
Yeah, so as I said, we are still trying to complete the puzzle of the infrastructure for all of our users, right? And as a centralized exchange, we are taking the responsibility of mass adoption for the industry because we have better infrastructures to support our users, like an easy to use trading platform, and we got our 24/7 customer services team to help our users in any time. And we might not design for a very specific type of users, but we are trying to suit the mass market. So I won't say all of our users are going to stay with us forever, but at least we could be a good guide for users of their crypto journey. Yeah.
Yeah, thanks for that. And Nathan, what about on your end? Yeah.
Yeah, definitely. So I think the role of exchanges overall is to just fill market needs, right? So what is it that users really care about? So some users care more about like the ability to trade a variety of markets. Some users care about trading specific types of assets. Users care a lot more about like decentralization, self-custody. So from our perspective at the ORDX, the niche that we fill is specifically decentralization, right? So the ability to self-custody your assets, audit everything in real time, full transparency around like what's happening with the protocol where funds are. So for us, that's why we're building V4 and why we'll ship it by the end of September, is that aim and our mission is to democratize access to financial opportunities. So full decentralization is a very big aspect of that. I think it remains to be seen how we expand our product offering after we fully ship V4, because at that point, I think the community has pretty much full say over like what continues to be built on DYDX specifically. But at the end of the day, I think exchanges overall just have to fill the needs of consumers. So everyone in the crypto ecosystem has a different niche to fill, whether it's an NFT marketplace, a centralized exchange, a decentralized exchange. At DYDX, obviously, we may be biased and think that decentralized exchanges are the best path forward, but that's not to say that users don't have a preference for centralized exchanges or decentralized exchanges or vice versa. So I think the most important thing is to do right by users and give them exactly what they're asking for. So I think the role of exchanges is just to build exactly what the users want to use. And that's the role that we fill as custodians or non-custodial exchanges.
Yep. And final question to wrap up the session. Just wanted to give you guys a chance to conclude and sort of tell us a bit of what are you feeling excited about this year. We got off to a decent start, and what are your hopes for the rest of 2023 and beyond? Alicia?
So I have experienced how the internet industry changed our lives from the beginning, right? So I'm quite expecting more real use cases of crypto in our everyday life. So the key would be infrastructure. So not only about the trading platform, not only about the yields, not only about like the derivatives. It's if we got more and more like brilliant infrastructure, and it will definitely help like more and more real use cases to the crypto industry and to get into our like everyday life. Yeah, that's my expectation.
Thanks for that. And Nathan, last words from you. Yeah.
Yeah, I think the last year has been very interesting for everyone in the crypto ecosystem, whether it's users, builders, exchanges. We've had several Black Swan events within the last year, from FTX to Terra Luna. So I think that what we're starting to notice is that users are becoming a lot more educated and a lot more vigilant when it comes to how they're using their capital and the types of services that they're willing to trust now compared to before. So what we're optimistic about is decentralization, obviously, at DYDX. But I think that on balance across the board, we've seen exponential growth in technology for blockchain, as well as user sophistication and innovation. So we're just really excited to see the ecosystem continue to grow. We hope to contribute to that with V4 and our specific mission of decentralization. But I think on balance, it's a very good time to be a crypto user and an investor because you have so many options that did not exist in the past before. So I'm excited to continue to see the ecosystem grow. Obviously, it is still a bear market, but I think that we've weathered the bulk of the storm. So I think the people that have stayed and the new users that will come in, I think we're in a very good spot as an industry today.
Yeah, I think certainly happy to hear that, that we've sort of, it seems like we've sort of weathered, the worst of the bear market, and hopefully it's just better days ahead for the crypto industry. And I think that's a good place to wrap up this panel discussion. Thank you so much, Alicia and Nathan, for joining us. It was a really interesting discussion. I definitely learned a lot, and I'm sure the audience did, about how exchanges are thinking about their businesses, how exchanges are going to evolve in the future as we try to attract more users and serve a larger subset of users and provide more services to them, right? So thank you again so much for joining us, Alicia and Nathan. I think just to close out this meetup, I just want to make sure that I thank KuCoin again for sponsoring the meetup. Thank you so much.
Thank you.
Yeah, Alicia's on the call. Thank you so much for continuing to support us. For those that have stayed to the end, there is one final thing to point out. So we have a promo code for our CoinGecko store. If you use the code CoinGecko5, you will get a $5 discount off our CoinGecko store. So if you want anything off the store, do feel free to use the code. Otherwise, this is it. Thank you so much for joining us and staying to the end. Take care, everybody, and we'll see you during the next meetup.
Thank you. Bye-bye.
Thank you.
Thank you for having us.